Let us see this quotation which I have taken from internet. There are a few things that I want to explain you from this. See, this is what I have taken on 15th of January. That is the date for which the quotation is there. It is for the security of Reliance Industries Limited. You can see that it is the stock derivative. The term stock stands for the security, and over here it is the equity share. The term stock has a broader meaning. Stock means security that includes equity shares, preference shares, debentures, and so on. Over here the stock derivative means the equity share derivative. You can see that's the instrument type, in that the stock futures, like that it is provided. Symbol, it is Reliance. It is 28th of January. Why it would be 28th of January, friends? Because in the month of January, last Thursday must be 28th of January. That is the reason. Now going 1 minute that is ahead, the same thing is there, 25th of February. Why 25th of February? Because in the month of February, the last Thursday must be 25th of February. And in March, it is 25th of March. Why? Because it must be the last Thursday of the March month even. That is the reason. So as what we had discussed yesterday, in case of the futures contract, you will be having at one point of time, so the 3 futures contracts available. So on 15th of January, when I opened the terminal, I found that the 3 futures date, 28th of January, 25th of February and 25th of March. That is the way, so these are the 3 dates. Now, the next thing that just I want to tell you is something like this, that you can see that the information is provided for the market lot. It is 250. What does it mean? It means that 250 shares, or in multiple of that only you can do the transaction. You cannot do the transaction for any number which is not in multiple of 250. So friends, you can see that over here buy quantity in that 250, 250, 250, 250, 250. Sale quantity 500, 250, 250, 250, 250. What I want to tell you is that the buy quantity, sale quantity would be 250 on in multiple of that only. There cannot be anything else. Yeah. My question to all of you is this. I want you to tell me answer. Suppose I want to purchase Reliance futures for January for 1000 shares. What would be total purchase price? Yes, I want somebody of you to tell me like this. See, when we understand that I want to do the transaction for purchase. Am I correct? I want to do the transaction for purchase. Now I want to purchase, so I have to see that who is ready to sell. So we understand that this is what the relevant is. Let's say somebody is ready to sell the Reliance in futures at the rate of 1947.80, 500 shares. 1947. So 1948. 1948.70, 250 shares, and 1948.75, again 250 shares. So we understand that say the total 1000 shares if at all I want to buy, then 1947.8 into 500. So that comes to 9,73,900. Then 1948.7 into 250. So that comes to 4,87,175. 1948.75 into 250. That comes to 4,87,187.5. So the total purchase price would be 973,900 plus 4,87,175 plus 4,87,187.5. That comes to 19,48,262.5. This is the total purchase price that we have. So friends, we understand that say if at all I want to do the transaction for the purchase, then in that case I have to see that say these are the prices at which immediately I can buy. I can buy say 250 or in multiple of that only. So if at all I want to do the transaction for 1000 shares, then in that case say these are the number of shares so to which I have to see. This is the way we understand that say the kind of the futures quotations that say we have. Now the same thing is there for the month of February and same thing is there say for the month of March. This is for the month of March. This is February and this is the January. Okay. I did the answer with the February quotation. So let us take that. Let's say this is the February. Okay. Okay. Now listen to my question carefully. Suppose on 15th of January, comma, I enter into futures contract for the month of March, comma, this time March I am writing it consciously, for the month of March to buy Reliance one lot, full stop, on last Thursday of March, comma, spot price is rupees 2000. What will be my profit or loss? Question mark. So friends, over here we understand that say on 15th of January you enter into the transaction for the month of March to buy Reliance. So we understand that say on 25th of March the March futures contract will expire and this is the price at which you must enter into the transaction to buy, and so there is one lot for which the transaction is entered upon. I understand that so the price is 1957.45. Just correct me. 1957.45. That is the price at which you enter into the transaction to buy. On the last date, the spot value of the commodity, that is in the cash market, which we have seen in the very first page. So 1957.45 is the price at which you will buy, 2000 is the price at which you will sell, and difference of that will be your profit. So 2000 minus 1957.45, that comes to 42 rupees and 55 paise. Into 250 shares, that comes to 10,637.5. This is the way, say, you will have the profit. Yeah, question number 2E, next question. Spot price of the security X on 1st of January is 200. Rate of interest is 25%. Calculate F price for the security for 1 year. That is the question. Please write an answer along with me. Answer of question number 2E in the write down. F is equal to spot plus interest. So spot is 200, rate of interest is 25% and time period is 1 year. So 200 plus 200 into 25% into time period is 1 year. So 200 plus 50 rupees that comes to rupees 250. That is the answer of the first question. Second, the question says that if forward slash futures price of the security is 260, ascertain first whether arbitrage exists, that is a question. Calculate arbitrage in absolute term, second question. If the spot price of the security is 275 on 31st of December, calculate the profit or loss for above transactions as in B, that is a question. So question number 2A, 2B and 2C, that is the way there are 3 questions. 2A, we can see that so the futures price is 260 or the forward price is 260, which is other than 250. So as these two prices are different, so an opportunity of arbitrage exists. That an answer? As actual F price differs from theoretical F price, comma, so arbitrage exists. In a way that say both of them are different, so arbitrage exists. We can say that say 250 is not equal to 260. Answer of the B question. The question says that say you are required to make the calculation of arbitrage in absolute term. Everybody is requested to pay attention. Let us see that say what kind of transactions are required to be entered upon for the purpose of arbitrage. See, today's date is 1st of January, end of the year is 31st of December. Actual price is 260. It is more than the theoretical price of 250. Actual price is more than what it should have been. So we understand that say we should enter into the transaction for sale of underlying asset. Now doing the transaction of the sale of underlying asset is the first thing that we understand. Why? Because the actual price is more than what it should have been. That is what we understand. Now importantly, what happens that say doing this sole transaction will not give an assurance of the profit. Why? Because it may happen that say on 31st of December The price of the security is rupees 300. So purchasing the security at 300 and selling at 260 will have a loss. So no, doing this sole transaction will not give an assurance to you that say you will be able to make profit. So what happens at say whatever you are going to do at the end of the year, opposite of that say you will do today. So today on 1st of January you will enter into the transaction for purchase of underlying asset. What is the purchase price? Purchase price of the security is 200. In order to purchase the security today, what you will do friends? You will borrow rupees 200 at the rate of 25% for 1 year. So you will borrow rupees 200 at 25% for 1 year. With that say you will purchase the security today. And of course, you will enter into the F contract to sell security at the rate of 260. That is the way, say we will enter into these transactions today. Now if at all you do these transactions today, then what will happen? We understand like this. Since we have borrowed funds at the beginning of the year, so it will have say, the repayment of the loan. What is the amount of the repayment of loan? We understand that say we will have repayment of loan rupees 250. How 250 is calculated? It is 200 plus 25%. You had purchased a security. So you are holding a security and you also have entered into the F contract to sell security at 260. So whatever the security that say you are holding will be sold against F contract at the rate of 260. So sale value of security against F contract, and difference between both of them is the amount of the profit that you are able to make, 10 rupees, and that is what we understand is arbitrage. Let us answer the question. Answer of question number 2B. Okay, that is 2B. In 2E, second question in that B. Let an answer. First of January, 31st of December. Borrow rupees 200 at the rate of 25% for 1 year. Second, purchase security today at the rate of rupees 200. Third, enter in F contract to sell security at the rate of rupees 260. Now at the end of the year, 1. Liability to repay loan rupees 250. 200 rupees plus 25%. Second, holding a security. Third, holding F contract to sell security at the rate of 260. With paragraph write down. Calculation of arbitrage. Sale value of security 260, liability to repay loan 250. So the difference between both of them is arbitrage 10 rupees. Now I am dictating a note to you. This note is not at all forming part of the answer. Your answer is as short as this. Your answer is this much only in examination. For your understanding, I am dictating a note to you. Write on that note. First point. Actual F price is more than theoretical F price. Full stop. So, sale underlying asset in F contract. That is the first thing. Second, entering into only sale of underlying asset in F contract will not give an assurance of profit, comma, because it may happen that spot price on 31st of December exceeds forward price at which sale transaction is entered upon. Full stop. Third point, as we have sold underlying asset at the end of year, comma, today we will purchase underlying asset at spot price. Full stop. To purchase underlying asset from spot market comma we will borrow funds, full stop. I want all of you to go through the answer and the note that I have dictated to you. See, why I am telling you to go through the answer properly along with the reason is that, say, in the time to come there will be number of such questions that we will be having, and say when all these transactions will be combined at that point of time, unless you have a clarity, you will not be able to execute the answer. That is the reason. C question. If spot price of the security is rupees 275 on 31st of December, what will be the profit or loss from the transactions as in B? That is a question. I want you to tell me answer. See, the language of the question is, say, provided like this. If spot price of the security is 275 at the end of the year, calculate the profit or loss for the transactions as in B. That is the question. So what happens, we understand that the transactions in B means these transactions. In these transactions you can see one of the transaction is that, so you enter into the forward contract to sell the security at 260. So once you already have entered into the F contract, that is the forward slash futures, then in that case at the end of the year, whatever may be the price, you are going to sell the security at 260 and you will have, so the profit of rupees 10 only. Whether the price is less than 250, greater than 250, whatever may be the price, you are required to sell the security at 260 only. That is the reason, so this is given a name as arbitrage opportunity. What do we understand with the term arbitrage? Arbitrage means that, say, unconditionally, so you are going to make the profit only whatever may be the spot price. So the answer is rupees 10. Better answer? Answer of C question. There will be a profit of rupees 10 only, comma, as calculated in above answer. Full stop with paragraph write down. Importantly, F contract is entered upon. So whatever may be spot price at the end of year, comma, sale value of security will remain same. Full stop. Third question. If F price of the security is 235, ascertain A, whether arbitrage exists, and B, calculate arbitrage in absolute term. I want you to tell me answer of A question. Before I proceed for the third question, Just one point that I want to tell you for the second question is like this. Understand that carefully. For second part of the question, I am going to give you one additional explanation. See what happens at we understand conceptually that if the spot price of the security is today 200, then theoretically the futures price should be 250. This is what we understand. Now if at all the actual price is more than what it should have been, what everybody will do, everybody will enter into a transaction for sale of security in F transaction, in forward/futures transaction, and buy security from spot market. So what will happen if at all everybody will buy from spot? So what happens, let's say there is a fair chance that the spot will increase. Everybody will sell in futures, so the futures will decrease. There will be an equilibrium point at which these two prices will become, say, the equilibrium price, and the opportunity of the arbitrage will vanish from the market. The concept of the arbitrage is required to be understood in a way that it is a process which will bring the market into an equilibrium situation. How it would bring the market into an equilibrium situation? Because the forward is going to fall down because it is overvalued, and the spot will increase. So there will be a point at which the equilibrium will be established and the opportunity of the arbitrage will vanish from the market. This is the concept that we have. Just write down this conceptual point. We understand that due to above arbitrage process, comma, F will fall down and spot price will rise. Full stop. Both of them will change in such a way so that equilibrium situation will be established. Full stop. Friends, we understand that, say, if at all the actual price is different in comparison to what it should have been, then in that case always the arbitrage exists. See, the answer which I have dictated to you over here, just consider it. Actual F price differs from the theoretical F price. So what I have dictated to you differs. Differs means both of them are not same. In that case, the arbitrage exists. So any price which is other than 250 will have a situation of arbitrage. Let an answer for the C question. Let an answer for the C question. Sorry, third question. Question number 3A. In that, write down actual F price is different in comparison to what it should have been. full stop. So an opportunity of arbitrage exists, that on 250 is not equal to 235. I want you to tell me answer of the B question. Calculate arbitrage in absolute term. I want you to write the transaction and tell me answer. See, the logic is very simple. See what happens at, say, let me explain you first of all. Today's date is 1st of January. End of the year is 31st of December. The price should be 250. Actually it is 235. So is it undervalued or overvalued? We can say it is undervalued. The price is 235 only instead of 250. So we understand that, say, as it is undervalued, so at the end of the year, what we will do? We will purchase security at the rate of rupees 235. Again the same story. Now if at all you enter into the transaction of sole purchase, then then in that case it may happen that on that date the price of the security would be less than 235. Then you will have a loss. So what we have to do? Today we have to sell security. So today we will sell security in spot market at the rate of rupees 200. Second, whatever 200 rupees that you have received, that will be invested for 1 year. Invest rupees 200 at the rate of 25% for 1 year. Whatever the investment that you have made will have a maturity amount of deposit of rupees 235. So you will have, 250. So you will have maturity of rupees 250. Third, enter in F contract to purchase security at the rate of rupees 235. Why? Because we understand that the price is less than what it should have been, so it is undervalued. Fourth, we understand that you have sold security, so you are required to give delivery of the security. So what you will do, friends? Borrow security, comma, to cover up short position in cash market. So what you will do? You will borrow security to cover up the short position in cash market. Now at the end of the year, what will happen, friends? You will have the maturity amount of deposit 250. You are holding a F contract to purchase the security at the rate of 235. So you purchase the security at 235 and then you refund the security. Okay? Because what happens is you have a liability to, that is a refund the security. So at the end of the year, at 235, you will purchase the security against the forward contract in which you have entered upon, futures contract in which you have entered upon, and you will refund the security. You know that the maturity amount of the deposit is rupees 250, which is fairly more than 235. At the end of the year, spot price of the security may be 500, maybe 1000, maybe 5000. We are not concerned with that. Why? Because we already have entered into F contract to purchase the security at the rate of rupees 235. This is what we understand. Now in this calculation, there is one lacuna, that is the borrowing charges. Instead it is ignoring the borrowing charges, so also we are also ignoring the borrowing charges. If at all the borrowing charges information is given, then from that 15 rupees the borrowing charges will be deducted in order to make the computation of the net gain. This is the way we are required to write the answer. Now question number 3b, that is writing answer for the question. In that, write down 1st of January and 31st of December. In 1st of January, write down first point. Sale security today at the rate of rupees 200 in spot market. Second, borrow security comma to cover up short position in cash market. Third, invest rupees 200 at the rate 25% for 1 year. Fourth, enter in F contract to purchase security at the rate of rupees 235. Now at the end of the year, write down first point. Liability to refund a security second, maturity amount of deposit rupees 250. Third, holding F contract to buy security at the rate of rupees 235. Write down calculation of arbitrage. In that, write down maturity amount of deposit rupees 250. Less liability to refund the security comma by purchasing from F contract. So the price is 235. So there is an arbitrage of rupees 15. With paragraph write down, in above calculation, comma, we are ignoring borrowing charges. For security. Full stop. Again friends, from examination point of view, this is the answer that you have to write, nothing more. Now I am dictating a note to you for your revision purpose. This note is not at all forming part of the answer, and even right now you may skip this portion of the writing notes if at all you are very much clear with the concept. You may not write the note. So this note only for understanding purpose. Write down first point. Price of security is less than what it should have been. Full stop. So purchase security in forward market at the rate of rupees 235. Second point, entering into only forward purchase will not give an assurance of profit, because it may happen that on 31st of December price of security will be less than rupees 235. Full stop. So today we sell security. Full stop. In bracket I am writing opposite transaction is to be entered today. Third, borrow security today to cover up short position in cash market. Full stop. Fourth point, if everyone purchase security in F contract, comma, F price will increase and everyone sell security in spot, full stop, spot value will fall down, full stop. There will be a point at which these two prices will have an equilibrium point. Full stop. A question is here that, sir, can there be a time period of borrowing of 1 year so long, or can there be a futures contract for so long 1 year? Then friends, over here I would like to tell you like this, that theoretically when we are learning the concepts, then in that case these things we keep aside. For example, you were learning the cost of debenture, cost of preference share at your intermediate level or IPCC level, assuming the security is issued for perpetuity, which is not the case in India. In India, you have to issue the security for a certain time period only. It cannot be issued for perpetuity. Yet we learn those kind of examples. Same is the case applicable over here. Let's say in India, the situation is that say you cannot enter into the forward contract or the futures contract for stock more than 3 months, but that is not the case everywhere in the world. Second thing is that the borrowing is also restricted for a time period over here in National Stock Exchange and Bombay Stock Exchange, but that is not the case everywhere in the world. So to that extent we are ignoring certain practical points to be applied over here. We are focusing on the concept, that is the pricing of the futures contract. So for the time being we have to ignore all these things.